Hello, everybody, and thank you for joining me today. My name is JackLynn Harris, and today I am accompanied by Kathy Irby. And Kathy is with Commercial Bank of California, and she's actually here to give us information on, you guessed it, the finances and what it takes to invest in commercial real estate. So, Kathy, if you could just let everybody know what you do and what you specialize in, and we'll go from there.
Sure. Hello, everyone. Yes, my name, as Jacqueline said, is Kathy Irby, and I am with Commercial Bank of California. And what I do is I provide commercial real estate loans for clients. Most of my clients are typically savvy investors, but it's always nice to talk to people that are interested in starting to invest in commercial real estate, whether it be apartment buildings, commercial retail, whatever the gamut is, industrial, we do it all. So I would love to be able to share some information with you about that today.
All right, and thank you. And then once again, I definitely appreciate your time because we know you're busy. And then you have, how many years of experience do you have doing this?
I actually have over 30 years of experience doing this.
Okay, so you've seen it all. uh,
Yeah.
yeah. So all right, and then sophisticated investors, and if we want to break it down to first time investors who want to get started in investing in commercial real estate, don't know how, don't know where to start. A lot of times I tell them to start with you because you could tell them, where to go and guide them through the process because we don't know what we could shop for if we don't know how much building we could afford or if any building at all. So for you, when it comes to first time investors who are interested in purchasing property, what is the conversation usually like?
Okay, so typically a lot of times before the client even finds the property, they will reach out to me. And we have our initial conversation is about the dollar amount that they want to spend on purchasing a property, where it's located, and we talk about what the bank's requirements are in reference to purchasing that property. So for our bank and most banks, when you're applying for conventional financing, for commercial properties, typically the banks will do a 60 to 65% loan to value. And basically what that means is if we do financing of a loan to value of 65%, that means the investor is coming in with a 35% down payment. The other thing that we talk about is debt service coverage ratio requirements. And what that is that's looking at the income that's being generated by the property. And we look at the net income because we want to deduct the expenses that are related to the property. So when we look at the net income, we want to see, like on an apartment building, for instance, we have a requirement of a 1.2 debt coverage ratio. And what that means is you need to have 1.2 times of net operating income to be able to qualify for that loan. So say, for instance, we'll just use some simple numbers. If the annual payments are $10,000 on an annual basis, you need to have at least $12,000 of cash flow that's available to repay the debt on that loan. The other important thing that you should look at is when you're locating properties is the lease term, because that lease term needs to match the maturity of the loan. Typically on a commercial real estate loan, they're usually 10 years. And you have an option, at least with our bank, of a 5-year fixed rate, a 7-year fixed rate, or a 10-year fixed rate.
Five, seven,
And
and 10.
5, 7, and 10.
Mhm.
And say, for instance, you select that 5-year fixed rate. And the reason why you select that is because the rate is a little bit lower. Once you select that 5-year, in year 6, what will happen is the rate will reset, and it will reset to a new fixed rate based on the spread. So if we do a 5-year fixed rate, we're looking at the 5-year Treasury rate, and then we're looking at a 7-year Treasury rate if we do a 7-year fixed rate loan. What happens in year 6, if you selected the 5-year fix, it resets based on whatever the current 5-year Treasury rate is, plus whatever that spread was. So say, for instance, the initial 5-year Treasury rate was 2% when you initially got the loan, and then it had a spread of 2%. So your rate was at 4%. When it resets, and year 6, if the 5-year CMT rate is at 3% and your spread is 2%, then your rate would go up to 5%. And also the other thing to remember is most of these loans do have floor rates, and your floor rate is based on whatever the initial rate is. So whatever, if that rate was 4% when you initially did the loan, and say, for instance, in year 6, the rate goes down where your rate would be lower, you don't, what would happen is because there's a floor rate, the rate would not be lower than that 4%.
4%. Okay.
Right.
Perfect. All right, so let's backtrack a little bit because we are talking to beginner investors. So a lot of them aren't going to know what treasury rates are, spreads, and I believe you said CMT.
Right. And what that's the Treasury rate. CMT stands for constant maturity Treasury.
Okay,
But it's
so
just the Treasury rate.
okay, and then these treasury rates are what?
And the Treasury rates are set by the Fed. And so there is there are websites for the Treasury.
Mm-hmm.
And when you look at those websites, they do it based on whatever the Fed rate is. So they fluctuate, and they fluctuate on a daily basis. So right now, the Treasury, I believe, is at 1.75. So if I look at my rate sheet from last week,
Mm-hmm.
the 5-year Treasury was like at 3.38%. And
Okay.
like I said, those rates do fluctuate from day to day. And right now we're in a rising rate environment. So the Treasury rate is going in an upward direction.
Right, right. Okay, so we have that. So we have treasury rates. Now, if you can, explain spread to people that don't know what that term means.
Okay, so what the spread is the bank needs to make money. So when we are looking at the treasury rates, the bank is going to increase that treasury rate by a certain percentage. And most banks that you're looking at is some banks will be a lot lower than others. It depends. And also typically when you're dealing sometimes with larger banks, especially on apartment financing,
Hmm.
their rates may be a little bit more competitive than a smaller bank. And what that spread is, it's the spread. The spread is the difference between whatever the 5-year treasury is plus what the bank is charging you. So if the bank is charging you 4% and the treasury 5-year treasury rate is at 2%, your spread is 2%.
So is it always the 5% or is it 5, 7? It just depends on what
It,
treasury rate you get. That's
it
how the
is.
spread goes. It goes if you're getting 5, it's going to be 5, 7, 7, 10, 10, etc. Well, I guess it doesn't go past 10, but etc.
Right. At least not at this point.
Right, right.
Yeah.
All right. So that's good to know. So okay, so we got them to that point. Now, with first time investors, what are common mistakes that you see, and are there and the ways that could those mistakes could be avoided?
So I think that for a first-time investor, there's several important factors that they should look at. So you want to look at the vacancies in the area, and that's information that your realtor can provide you. And you want to make sure that you get a realtor that knows the area that you're looking at. And
Mhm.
then another important thing is to look at the city plans for the area, because if a neighborhood is changing, you need to know that because it could affect the marketability of your property. The other thing is underestimating expenses. When you're looking at a property, you want to look at, okay, hey, is this an older property? Or is there going to be a lot of maintenance that I need to do on the property? Are there going to be major renovation costs? And if they're going to be renovation costs, Is that going to be part of my loan? So do I need to get a larger loan because of the fact that I need to do, some major renovation? You want to look at, okay, what's going to be the annual amount of my mortgage payments, the cost of insurance, and your annual property taxes. So always wanting to know, taking into consideration what all your expenses are.
Right.
Another important thing to look at is you want to ask the existing owner for 3 years of operating statements. And so that way you can get the historical cash flow on the building. You'll know whether or not this building is making money or not. So that's very important. Also, you want to look at making sure you don't overbid on the property. And another reason why that's really important is because the bank is going to require an appraisal. And when we do an appraisal, we're going to lend based on the value of that property. So say for instance, a property, you bid on a property and you bid 500,000. And then when the appraisal comes in, it comes in at 400,000. That's what we're going to lend on.
Is the 400,000.
Exactly.
Okay. Question that I do want to ask you before we move forward is, given the market that we're in right now, we see that interest rates are rising. How do you all determine how to underwrite a property in the market that we're in?
So what we're looking at is cash flow. We talked about that a little bit about that earlier when I was talking about debt service coverage ratio.
Mm-hmm.
So when we're looking at the cash flow, depending on the type of property it is, we have a requirement, a certain threshold. And like I was saying, the debt service coverage ratio, what that is that's a measurement of the property's ability to cash flow the debt obligation on the property.
Mm-hmm.
So when we look at an apartment building, we're going to say, okay, well, what's the annual income that's being generated on this property? And we're going to look at the net operating income because we want to make sure that we've deducted those expenses. And that's how we determine does it qualify from a cash flow standpoint? And then we're
Yes.
looking at the value as well. And so the value cannot exceed that 60 to 65% LTV. Now, the one thing I will say is on apartment buildings, we will actually finance a higher percentage on our loan to value. We'll actually go up to like a 75% loan to value. So you
Okay,
would
so
only have
75,
to come in
25.
Right. So you'd come in with a 25% down payment.
I'm going to just ask you this, and you could tell me how to word it. If somebody who is a new investor purchases property now, and the interest rate is high, given the market that we're in, what can they do in order to? Is it a smart decision? I guess. Do you understand where I'm trying to go with this?
Yeah, I think I understand what you're saying. So here's the thing. When you purchase a property, you're
Mhm,
purchasing that property and you're going into that 5, 7, or 10-year fixed rate loan. So
mhm,
one of the things that's going to happen on commercial loans is there is a prepayment penalty associated with that. So
mhm,
that's why this market it's a tricky market because you're locked in for a certain period of time. So I'll
mhm,
give you an example. Say, for instance, you lock into that 5-year fixed rate loan. Like
mhm,
on our loans, typically on a 5-year fixed rate, you're going to have a prepayment penalty for those first 3 years. So in the first year, it will be 3% if you paid it off early. Second year, 2% prepayment penalty, and the third year, 1%. So you really have to gauge, you know what, is this a long-term investment for me?
mhm,
And if it's a long-term investment, then it's like, you know what, okay, then let me go ahead and move forward because I'm okay with the interest rate. I'm still going to have cash flow out of this property. So it
mhm,
makes sense for you. If you're looking at it like as a flip, then that's probably not necessarily the right decision for you.
mhm,
And when people are doing flips, typically what they do is they have a line of credit with a bank. And when they have that line of credit, when they have an opportunity come along, they can just advance against that line of credit and they can go ahead and they can purchase that property. So the one thing is, when you're a new investor, you may not qualify for a line of credit. So it's going to be
Mhm.
a little more difficult for you. So I would say that for new first-time investors, if you're going to buy in this market, it's probably wise that it's going to be a long-term investment, because you're going to get locked into that rate for at least 3 years. Like in the example I gave, you got that 5-year fix, and
Mhm.
then up to those first 3 years, you could have a prepayment penalty. So you want to make sure that you're going to go in with at least 3 years staying in that property. And then what happens after those 3 years are over? Then, say for instance, you're in the property for 3 years, it's making sense, and then the rates go down. What you do, instead of just looking for another bank, call your loan officer and say, hey, I've been looking at rates, I see they're down. Talk to another bank and see what type of rate they're offering. And then go back to your bank and say, hey, I'd like to stay with you, but I see that the rates are down. I'm no longer locked in. I don't have a prepayment penalty. I like to stay with your bank. Can you compete with this rate? Say, for instance, you got a rate of 3.9% or whatever it is.
Mhm.
But that's a way to negotiate, because most banks, they want to keep your business. So you contact them, contact your loan officer. And that was the other thing I was going to tell you, is that it's really important for first-time investors to build a relationship with their banker.
Yeah, and
Get
I
to
was
know the loan
actually
officer.
I was
Yeah,
actually going to touch on that too, because if you want to be close to anybody, you want to be close to your loan officer. That is one relationship you want to keep, and make sure you keep it fresh, keep it professional, and make sure you stay in constant communication, because you never know what loans could come, what changes may happen, and when it comes to situations like this, who do you want on your side? The person who's
exactly.
handling your money. So,
Ex-
of course, definitely those relationships matter, and you definitely want to trust the people that are handling the money. The reason why you went into this in the first place.
Exactly.
Yeah, that definitely makes sense. So when we're dealing with again, first time investors, what are some resources that are available to them?
So sometimes, because you are a new investor, you won't qualify for conventional financing. So there are several entities. Some of them are government ran, some of them are nonprofits that will provide you with resources and information. One in particular is called SCORE. And SCORE is a free program. And JackLynn, what I'll do is I will send you some information so you can provide some links to some of these websites. And it gives a lot of good information. And the information will is resources for grants, for also for commercial loans. The other thing that I did want to tell you guys about is, say for instance, you're a business owner and you're at the point where you're leasing your property, but now you want to buy the property that you'll operate your business out of. Sorry about that.
Yeah.
Um, and when you go to purchase this property, there's a program through the SBA called the 504 loan program. And in that program, you can get 90% financing for the purchase of the business property. You have to occupy at least 51% of it. So you could buy a larger property that you would actually occupy 51% of it, and then the other 49% of it, you can lease it out.
Right.
So that's another program that would be available. SCORE is, I forgot what the acronym means, but what it is it's mentors. And they're business mentors, and they're from various industries. It could be a commercial real estate investor, several types of business owners. And what they do is they act as your mentor in helping you to develop your business plan, or if you're investing in real estate, giving you some information as far as aspects that will help you. and sharing their background knowledge basically that can help you as either you're starting a new business or you're growing as a commercial real estate investor.
All right, sounds good. And then that was a good information. That was perfect. And then in addition to, I do want to let you know that I did let people know that I was going to be talking to you. And one of the individuals asked a question in regards to credit and the importance of credit when it comes to investing. So can you explain again the importance of credit when it comes to investing and how the amount of money you qualify for or the cost of money per se is affected by your credit score or vice versa, however it's supposed to be worded.
Yes, that is very true. So credit is important, very, very important, even when you're a commercial investor, commercial real estate investor. So, say for instance, you create a LLC entity, and that LLC entity is what you're going to utilize to purchase your properties. The bank is still going to look at you as an individual, the owner of that LLC, and we're going to still pull a credit report for you. So your FICO score is important. The average FICO score, I believe, is in the mid 600s. But what you want to do is you want to have as high as credit score as possible because that does affect the cost of the credit for you. So it can affect your rate being higher, and it also could cost you not qualifying for a loan if you have a poor credit score. So keeping your credit clean by paying all of your bills on time, whether it's a credit card, car loan, if you own your own personal residence, that's all very important because the way your FICO score is calculated, there's several factors, but one of the most important factors is how you pay and do you pay on time.
Mm-hmm. All right, which is definitely important. So there you go. There's the answer for you. So with that said, was there anything else you wanted to add to the interview, or any other important information you felt was important for first-time investors? Anything you want to add?
I think the other thing that you want to ask about when you're talking to your loan officer, and it's good to do your research up front, is ask about the bank's costs. Because there's not only just the interest rate associated with the loan, but there's like an origination fee, which is usually typically 1% of the loan amount. There's the out-of-pocket costs. You have to pay for the appraisal, the phase one report, title insurance. All of those are costs associated with the loan, and those are going to be out-of-pocket expenses to you.
And that's when
And
the term pity comes in, right? So
right,
yeah, so principal, insurance, taxes, and the last I,
um, wait,
principal.
principal, insurance, taxes, and interest.
And there you go.
Yes,
Yes. So you want to make sure that you have all that in place
right,
with your loan.
exactly.
So it's all important. All right. So yeah, that's great information to know. So that's everything for this episode, I think, Miss Kathy
Okay.
Irby. All right, so I am going to put a link to Miss Kathy's information down in the bio so you all could get in contact with her. She also has a profile on LinkedIn. And you are located in what city?
I'm in Santa Monica.
In Santa Monica, beautiful Santa Monica.
Yes,
That must be nice. So,
right by the beach.
but all right. Well, I do thank you for being here with me today. And then definitely we have to do this again. That was a lot of great information you were able to provide.
Oh, my pleasure.
All right. Thank you and you enjoy.
Okay, you do the same.